On December 8, 2025, the illusion of the free market officially dissolved. It didn't happen with a bang, or a declaration of war, or a stock market crash. It happened with a single notification on a social media feed. For the last 3 years, you have been told that the United States is engaged in a high-stakes blockade to starve China of artificial intelligence. You were told that banning advanced chips was a matter of existential national security. You were told that we were building a wall around the future. But on that Monday morning, the United States government admitted that the wall has a door, and they are charging admission. President Trump announced that Nvidia, the most important company on Earth, is now permitted to sell its most lethal technology, the H200 AI accelerator, to our primary geopolitical adversary. But there is a catch, a condition that has never existed in the 200-year history of American capitalism. The United States Treasury will take a 25% cut of every single sale. This is not a tariff. This is not a sanction. This is a protection racket. We have moved from blocking the enemy to charging them a subscription fee for their own rise. The government has effectively merged with its largest corporation, turning the Department of Commerce into a for-profit hedge fund. You are watching the birth of the sovereign corporation. To understand why this deal terrifies the intelligence community and exhilarates Wall Street, you have to look past the headline number. You have to look at the hardware itself. For the last 2 years, the United States has enforced a rigorous blockade, preventing China from accessing the frontier of computing power. The only thing Nvidia was allowed to sell them was a chip called the H20. It was a neutered product, deliberately crippled to comply with US regulations, offering a fraction of the power needed to train massive AI models. Washington thought this was checkmate. They were wrong. The H20 was a failure, not because it was too powerful, but because it was too weak. Beijing simply refused to buy it. They issued informal guidance to their tech giants, Alibaba, Tencent, ByteDance, telling them to stop purchasing Nvidia's crippled chips and instead support domestic champions like Huawei. This was a disaster for Nvidia. They weren't just losing a quarter, they were losing a market. The company was facing an $8 billion revenue hole in their balance sheet for 2026. They were sitting on $5.5 billion of unsold silicon inventory that nobody wanted. The chip war was backfiring. It wasn't slowing China down. It was forcing them to become independent, while simultaneously bankrupting one of America's most strategic assets. This is where the narrative shifts from a story about technology to a story about raw power. Nvidia needed a bailout, but not the kind that comes from a bank. They needed regulatory permission to sell a product so good that China would have no choice but to buy it, regardless of the political cost. Enter the H200. This is not a watered-down chip. This is a monster. Independent analysis from the Institute for Progress confirms that the H200 is approximately 6 times more powerful than the chips previously allowed into China. It utilizes high-bandwidth memory that drastically accelerates the training of large language models. By authorizing this sale, the United States is effectively handing over the keys to the next generation of artificial intelligence. We are allowing Chinese labs to build clusters that rival our own supercomputers, arguably narrowing the gap between US and Chinese capabilities to less than 18 months. So why would a nationalist administration, one that campaigned on America first and being tough on China, agree to arm the adversary? Because the nature of the conflict has changed. We are no longer trying to stop the flow of technology, we are trying to monetize it. This is the dawn of trade rent-seeking. The logic is cold and transactional. If China is going to get the chips anyway, through smuggling networks in Shenzhen or by developing their own, then the United States might as well be the dealer. The 25% sovereign fee is projected to generate over $10 billion a year directly for the US Treasury. That is pure profit, extracted from the trade flow of a private company. It transforms the US government into a silent partner in Nvidia's business model. But there is a massive legal hurdle standing in the way of this cash grab. The United States Constitution explicitly forbids the taxing of exports. Article 1, Section 9 is crystal clear. No tax or duty shall be laid on articles exported from any state. So how did they do it? How did the White House and Jensen Huang engineer a workaround that effectively deletes a line from the Constitution? The answer lies in a logistical shell game involving Taiwan, a loophole so elegant and so cynical that it redefines the concept of the rule of law. The solution they found is a masterclass in legal engineering. To understand the trick, you have to understand how Nvidia actually operates. Nvidia is a fabless company. That means they designed the chips in Santa Clara, California, amidst the manicured lawns of Silicon Valley, but they do not physically manufacture a single one of them. The actual silicon, the physical H200 chip, is fabricated by TSMC in Taiwan. Normally, for a global sale, these chips would be shipped from Taiwan directly to the customer in China, or perhaps through a logistics hub in Singapore. But under the December Accord, the supply chain has been weaponized. Here is the mechanism. The chips are manufactured in Taiwan. But instead of going to China, they are shipped across the Pacific to a US logistics hub. The moment those chips touch American soil, they are legally classified as an import from Taiwan. And because Congress has broad powers to tax imports, the Trump administration can slap a 25% tariff on them without violating the Constitution. Once the tax is paid to the US Treasury, the chips are cleared for security and re-exported to approved customers in China. The administration has essentially taken a global supply chain, bent it through a US customs checkpoint, and turned a constitutional prohibition into a $10 billion revenue stream. It is a legislative sleight of hand that transforms the Department of Commerce from a regulator into a profit participant. But this mechanism is not just about the money, it is about the asset. And this is where the story gets darker for the national security hawks. The White House is selling this deal as a tiered containment strategy. The argument is that we are keeping the absolute best technology, the Blackwell B series and future Rubin chips, for ourselves and our allies. We are keeping the Tier 1-inch capability that allows for training trillion-parameter models in days. China, they argue, is being relegated to Tier 2 inches technology with the H200. They claim that monetizing the second-best chip is smarter than banning it, because China would just smuggle it anyway. However, anyone who understands the physics of AI knows that Tier 2 is a deceptive label. The H200 is not a toy. It is a performance monster. The critical bottleneck in training AI is not just raw calculation, it is memory bandwidth, how fast you can feed data into the brain of the chip. The H200 utilizes HBM3E memory, which drastically increases the speed. The Institute for Progress notes that the H200 is almost 6 times more powerful than the neutered H20 chips we were previously trying to force China to buy. By granting access to H200s, we are effectively allowing Chinese tech giants like Alibaba and Tencent to build clusters that rival the top supercomputers in the United States. Critics argue that the tiered containment strategy is a fantasy. They point out that while a single H200 is slower than a Blackwell chip, you can bridge that gap with brute force. If you buy enough H200s, you can simply scale your way to parity. We are not selling them obsolete tech. We are selling them a time machine. We are selling them the ability to catch up to US capabilities within 18 months, rather than being locked out entirely. And let's be clear about the precedent this sets. The closest operational comparison we have to this deal is the Foreign Military Sales Program, where the Pentagon sells weapons to allies and charges a small surcharge, around 3.8%, to cover administrative costs. That is a service fee. This deal with Nvidia charges 25%. That is not a service fee. That is a royalty. The United States government has looked at the intellectual property of a private company, decided that it is a strategic national asset, and demanded a quarter of the gross revenue. If Nvidia sells $40 billion worth of chips to China, a very plausible number given the pent-up demand, the US Treasury nets $10 billion. This fundamentally changes the incentives of the US government. For the last 3 years, the goal of the Commerce Department was to limit the number of high-end chips going to China. Now, the US government has a direct financial incentive to maximize the number of chips going to China. Every H200 that lands in a Beijing data center pays for a bridge in Ohio or a tax cut in Florida. The regulator has been captured by the revenue. Nvidia has been converted from a private multinational corporation into a government-sponsored enterprise for the duration of these transactions. But there is one player in this deal we haven't discussed yet. We've looked at the seller, Nvidia, and the broker, the US government. But what about the buyer? Why would Xi Jinping, a leader obsessed with technological self-sufficiency, agree to pay a Trump tax to his rival? Why would Beijing humiliate itself by paying a 25% premium to the US Treasury? The answer reveals a desperate secret about the state of China's economy and the $8 billion catastrophe that forced this deal to happen. The narrative you have been fed by the financial press is that Nvidia is invincible, a company with unlimited demand that can sell every chip it makes. That is a lie. The truth is that throughout 2025, Nvidia was quietly bleeding out. The chip war was not just hurting China, it was strangling Nvidia's most profitable revenue stream. To understand why this deal happened, you have to look at the disaster of the H20 chip. This was the product Nvidia designed specifically to comply with the Biden administration's export controls. It was a safe chip, stripped of its most advanced capabilities. Nvidia assumed China would be grateful for whatever scraps they were thrown. They were wrong. By mid-2025, the strategy had collapsed. The Chinese government, specifically the Cyberspace Administration of China, issued what is known as window guidance, informal but binding instructions to its tech giants. The message was clear: stop buying the H20. Beijing viewed the chip as an insult, leftover technology that was barely better than what Huawei could produce domestically. They decided that if they were going to be contained, they would rather force their companies to buy inferior Chinese chips than pay a premium for crippled American ones. The result was catastrophic for Nvidia. In earnings calls that were carefully managed to avoid panic, CFO Colette Kress admitted the company was staring down an $8 billion revenue hole for the second quarter of 2026 alone. They were forced to take a $5.5 billion inventory write-down on H20 silicon that had been manufactured but effectively banned by the customer. The December Accord wasn't a victory lap, it was a rescue mission. Nvidia needed a product good enough to break Beijing's boycott. This brings us to the other side of the table. Xi Jinping. Why would the leader of the Chinese Communist Party, a man who has staked his legacy on indigenous innovation and ending dependence on the West, agree to a deal that directly enriches the US Treasury? Why pay a 25% tribute to Washington? Because the self-sufficiency drive has failed to meet the immediate, existential demands of the AI race. Despite pouring hundreds of billions into the big fund, China's semiconductor champion, SMIC, is still struggling to produce advanced chips at scale without access to ASML's lithography tools. The harsh reality on the ground in Shenzhen is that Huawei's Ascend chip simply cannot compete. Reports from the Institute for Progress reveal that while Huawei's chips are functional for smaller tasks, they are a nightmare for training massive frontier models. They suffer from poor interconnect speeds and lower yields, making them prone to malfunction and hard to fix. For companies like ByteDance and DeepSeek, who are trying to compete with OpenAI and Google, relying on Huawei is a death sentence. They cannot afford to wait 5 years for domestic technology to catch up, while the rest of the world races ahead. They need Nvidia's CUDA ecosystem, and they need the reliability of HBM3E memory right now. So Xi Jinping made a cold, pragmatic calculation. He agreed to the deal because he is engaging in, quote, geopolitical arbitrage. He is trading cash, which China has in abundance, for time, which China lacks. By agreeing to pay the Trump tax, Beijing is effectively subsidizing the US government in exchange for keeping its AI ecosystem alive. It is a humiliation, yes, but it is a calculated one. They are paying for the privilege of staying in the race. This transaction redefines the relationship between the two superpowers. It is no longer a total blockade. It is a revenue for relevance trade. China pays the fee, Nvidia gets its stock price back, and the US Treasury gets a new revenue stream that rivals the GDP of a small nation. But there is a cost to this easy money. By turning sanctions into a business model, we have shattered the bipartisan consensus on national security. In Washington, the reaction has been nuclear. Senators and defense hawks are calling this a, quote, colossal national security failure. They argue that we are gifting Beijing the capacity to modernize its military and cyber warfare capabilities in exchange for a short-term payout. They see it as selling the rope to the hangman. But the proponents of the deal argue something far more cynical and perhaps more realistic. Containment is leaking anyway. If the chips are going to flow through the black market, we might as well be the ones collecting the toll. We have entered a new era. The free market is dead. We are now in the era of negotiated markets, where access is granted not by supply and demand, but by the state, in exchange for a cut of the action. Nvidia is no longer just a tech company. It has achieved sovereign status. It negotiates with nations as a peer. It has its own foreign policy, and its stock price is now a derivative of the United States' willingness to rent out its hegemony. But if you think this ends with chips, you aren't looking at the horizon. This model, the sovereign fee, is a prototype. And now that it works, it is going to spread. This is not just about one company, or one chip, or one country. The December Accord is a prototype for a new economic operating system. If this model succeeds, if the United States can successfully force its geopolitical rival to fund its own treasury in exchange for technology, we will see it replicated everywhere. President Trump has already signaled that this same sovereign fee approach will be applied to AMD, Intel, and other great American companies. We are witnessing the end of the global free market and the beginning of a tech mercantilist world order. Imagine the next decade. It won't just be silicon. We could see a 25% sovereign fee on American biotechnology exports, a tax on access to US-hosted quantum computing clouds, a royalty on green energy intellectual property. The United States is signaling that it intends to monetize its dominance in every critical sector to fund the federal government. This is the era of trade rent-seeking. The old model of sanctions was designed to deny the enemy capabilities even if it cost us money. The new model is designed to regulate the enemy's capabilities specifically to extract a profit. The United States government is no longer acting like a neutral arbiter of commerce. It is acting like a majority shareholder in the national portfolio, demanding its dividend. The boundary between the state and the corporation has dissolved. Nvidia is now a sovereign corporation. Its balance sheet is entangled with the national interest. Its CEO is a diplomat. Its products are leveraged. The risk, of course, is high. If China successfully clones the H200, or if a future Congress passes legislation to block these deals, that $10 billion revenue stream evaporates overnight. But for now, the trade is on. The chips will flow, the tax will be collected, and the line between the Pentagon and Silicon Valley has blurred until it is invisible. There is a question that every investor and citizen needs to answer right now. Is this deal a stroke of America First genius, a way to force our adversary to subsidize our economy? Or is it the ultimate sellout, trading long-term national security for short-term revenue? I want to see your argument in the comments. If you want to understand the mechanics of power that the mainstream media refuses to touch, make sure you are subscribed.